Have you ever wondered what separates the mediocre investors from the good ones? I can tell you, it's not luck, it's not timing, it's understanding value. Warren Buffett, one of the greatest investors of all time, famously said, "Price is what you pay, but value is what you get." And this is a simple but also very powerful statement. While the price of a stock is easy to see since it's set by the market, understanding a company's true value is much trickier, especially if you're new to investing. If you don't know me yet, my name is Johnny and I spent the last years in corporate finance and private equity. In this video, I want to share what I've learned to help you become a better investor yourself. I will walk you through the fundamentals of valuing a company so you can analyze a company's value and make smarter and more confident investment decisions. First, I will introduce some fundamental topics that might seem basic at the beginning, but are often misunderstood by many beginners. Second, we will apply some of those foundations in a practical context by valuing one company, Apple, together. Now, the first part may feel a little bit theoretical, but trust me, stick with it as there's some gold nuggets in there for you. The theory will pay off once we will get to the practical part and actually value a company. So let's get started. As you probably know, when you're buying a stock, you're actually buying a tiny stake of an overall business. So of course, in order to find out what the stock is worth, you first need to assess the value of the overall business, right? And to do so, you must start viewing companies as a cash generating asset that generates income for its owners over time. This is why the starting point of every valuation analysis is always the cash flow or the profit generated by the respective company. Let's work with an example. Imagine you're the owner of a business that generates $1 million in earnings consistently. So let's assume the company operates in an industry where company valuations are on average around 10 times earnings. This 10 times is to refer to as the valuation multiple that you can now apply onto your business to get an idea of what the company is worth. As you probably know, there are a couple of different ratios out there. Enterprise value over sales, enterprise value over EBITDA, just to name a few, right? So in this scenario, the company is worth 1 million in EBITDA times 10 times EV over EBITDA, which equals an enterprise value of 10 million. If you're not familiar with the expression EBITDA, it basically means earnings before interest, taxes, depreciation and amortization. It's a common earnings metric used because it's a good cash flow proxy. So now we know that the value of the company is somewhere around 10 million, right? So far, so good. So this is the value of the operating assets, the asset value, which is, like we said, 10 million. We now need to adjust this value for any non-operating assets. Let's say, for example, the company has been generating cash and accrued 2 million in cash over the last years, which the owner never distributed, right? Then we would actually have to add this non-operating asset, this cash, to the enterprise value. This would now give us a new value of 12 million for the company. In addition, let's also say the company has 5 million in debt. How much is the company now worth to the shareholder or owner, right? So we would actually have to reduce the value by 5 million from the original 12 million, which now gives us what is called the equity value, also referred to as a market cap for public companies. In our example, we now have an equity value of 7 million. In reality, the definition of debt is a little bit more complex, and you would probably have to review the balance sheet of the companies in more detail to find out what the exact debt is, right? Also note, very often debt and cash are netted, which is also referred to as net debt, right? This analysis is also referred to as EV to equity bridge by investment bankers, right? You now understand the difference between enterprise value and equity value, or also referred to as market cap. When you're buying a stock, you're essentially buying a piece of the equity of the company. Let's try to apply our knowledge by valuing Apple. For that, I like to use just a plain Excel sheet. And we can basically input what we just learned by, looking it up on Seeking Alpha. So let's check if we can find the EBITDA real quick in the financials here section, and it's 139 billion. Let me just copy this real quick and we input it here. And the EV/EBITDA multiple, make this is an enterprise. Enterprise value is let's go real quick to valuations, and we can see currently the EV/EBITDA is around 1.4, which is an enterprise value of around 3 trillion. Yes, that's approximately what we get also here at Seeking Alpha, right? And now let's do the EV to equity bridge as we discussed, right? So we add the cash and we deduct the debt, right? To get to what is called the market cap. Similar to, how it's actually done here in Seeking Alpha, but it's also good to understand the logic behind it. So we can just take what's here directly. We include here the cash and the debt, right? Okay, so format this correctly, and then we calculate the correct minus. So we end up with a market cap of around 2.9 trillion, right? You add the cash and you deduct the debt. So now we need to divide the market cap by the number of shares outstanding to get to the current share value, right? And then we want to compare it with the share price. Just for you to know, the share price of Apple currently stands at around 0.201, right? And depending on the number of shares, let's really quickly check that metric. Here, diluted weighted average shares outstanding, it's around 15 billion, right? So let's include this right here. So we take the market cap divided by the number of shares outstanding, and there we have the share value, which is not the share price. Let's just include delta here. So the delta is around 8, right? And now, depending on what you think the fair enterprise EV to EBITDA ratio is for this company, right? You can now decide what you think is fair, right? If you think the enterprise EV to EBITDA multiple should be lower, more around 18 times, then the value of the share is lower than the actual share price right now. So if you would assume, 18 times is fair, certainly Apple would probably be overpriced right now because the value of the share is lower than the share price, right? And how can you find out if this is a fair multiple? You can, for example, look at peers right here. At peers, for example, there are a couple of Dell, for example, right? You can check Dell's EV to EBITDA ratio, which currently stands at 10 times, which is half of where Apple is right now. Okay. So that's pretty much it. So If you got this far, thank you for watching. I hope you got some value out of this, and if you want more content like this, please do subscribe and leave a comment below. Other than that, happy investing.